therapist, and a doctor. I'm your co-host, Judy Grant, licensed marriage and family therapist.
And I'm your co-host, Dr. Sophia Grant, board-certified pediatrician and board-certified child abuse pediatrician.
So nice to have you all with us today. So let's just do a little catch-up, Candy. What's going on?
Well, let me see. I'm trying to get all my receipts together for tax season.
Yeah, yeah. I've been thinking about that too, and I've been holding off making that appointment. But all of my documents are coming in, and I should be ready to go here in no time, which actually is a great segue into our guest today. Candy, you want to introduce Kathy to everyone?
Yes, Kathy Shirley. First of all, she's the biggest booster for USC I have ever met. I think she closes every email with "fight on." But she is the president of World Management Solutions, and she is also a CPA. So that's a certified public accountant. So your undergrad degree, was it in finance? And then you moved to business. And she's going to be our guest.
Welcome, Kathy. It's so nice to have you with us today.
Thank you for having me.
All right. So, Kathy, I mean, the thought of taxes just kind of makes me nauseous, you know? But it's something we have to do. And I was wondering what people need to do to make sure they don't get in trouble with the IRS.
Oh, that is a wonderful question. The first thing is as we said already, we need to get all of our tax documents together. It's really an easy thing, and I don't want people to be afraid of the IRS because they are gentle as long as you respond to them, even if
Mm-hmm.
something does go wrong. But really, the number one thing is during this time of year, as your tax documents come in, just put them all together in a folder. And you have to also remember that some documents are sent to you electronically now. And so
Mm-hmm.
if you're sitting waiting for a 1099 or a W-2, it may have been uploaded into a portal for you. But I really want to emphasize that you need to start before tax season comes. You need to do planning all throughout the year and just make sure that you're ready for this time.
So let's pause here. And Nikita, do you want to try to upload that?
No, he texted us. He said,
Oh,
uh-huh.
we're good. Okay.
Okay.
Okay, so we will pick up. And Kathy, you said what now?
I was saying about the planning. You
Mm.
actually need to start preparing for taxes, not during the tax season, but months before.
Okay,
So
like
can you
what does
elaborate?
planning
Yeah.
include? Yeah.
Yes, please.
Oh, I am so sorry. Absolutely. So throughout the year, there are many things that happen within your life, and a lot of times there's tax consequences. Let's just say that you are interested in selling your home. Well, you may have capital gains if you sell your home. And there are so many different rules, and I'll just kind of get into this one as an example. You
Mm-hmm.
can sell your home every 2 years and be able to get a capital gain exclusion. But if you sell it before 2 years, you actually do not get that exclusion and you end up paying lots of taxes on your home. And so, my thing about planning is that you really have to stay in contact with your CPA throughout the year, just because you might not think of a thing as being that it might have any tax implications, but just letting your CPA know what you have going on in your life, that helps them to let you know to keep your eye out for certain things and to be
Mm-hmm.
prepared for certain things.
So I think we know about like the big events, like the birth of a child, right? That you can now claim them as a dependent on your taxes. But, and you mentioned the sale of a house. Can you give us another example or two about what those things might look like? Because personally, I don't know that I know all of them.
Abs- Yeah, absolutely. Getting married, getting divorced, getting separated, having a child go off to college, Oh my gosh, selling a house, buying a house, starting a business, dissolving a business. There are just so many things that,
Mm,
you have to consider tax implications for.
wow. Okay.
So, what do people get in trouble with the IRS for? I mean, obviously not filing your taxes,
Right.
cheating on your taxes, lying. Okay, what are other situations where people get in trouble?
Yeah, and I'll just kind of tell you, the IRS right now, they're ramping up their auditing because they received a big infusion of cash from the United States government. And so there are certain businesses that the IRS are always going to have an eye on. And usually
Mm-hmm.
those are businesses that are cash bases. And so you think a beautician or someone,
Mm.
again, it's going to be a cash exchange. They went after the entertainment industry a while ago because the production companies were issuing 1099s and not treating their people as employees and not paying payroll taxes. Those kind of things, you really can't control. But I will say that the IRS is looking at partnerships and S corporations now. And so the way people get in trouble is not reporting all of their income and over reporting their expenses. And so really, when it comes to expenses of your business, you have to write off things that are ordinary and necessary. Some people just kind of go a little bit, a little bit too much, and they write off too many expenses that really had nothing to do with businesses. One in particular that I can think of is the business use of an automobile. What people are supposed to do is keep track of their mileage
Mm,
and actually their actual expenses as well, and then they can write off a portion of those expenses. But what we're finding that people are doing is that they're trying to write off their entire vehicle when they know that they're using it for business and personal use. and
sure.
and so really it's really when people are trying to get a little extra when it
Mhm.
comes to those expenses. And you'll find that the reporting now for income, it's increased so much now. The burden has really been pushed back on whomever is making those payments and also CPAs to make sure that people are reporting income. And so even if you do a job and let's just say that you only made $500 and you're not issued a 1099, you really need to report that income because if you are audited, the IRS can actually dig for your bank statements and really just, they can find the money. They will definitely find the money. And I know that a lot of times people are thinking, oh, I'm not going to get audited. But again, because of the infusion of money, the auditing has increased.
Mm-hmm.
What's
Okay.
a common mistake that people make? Is it they assume something, like, I mean, if you have a home business, you can claim your office, you
Hmm.
can claim supplies, you can claim internet. What is something that people forget to claim?
Let's see. Let's just talk about equipment. So your cell phone, a
Hmm.
computer, a laptop, those type of things are what people usually forget. But you have postage. There's all the things that I tell people. What you need to do is any cost you incur to try to make money for that business. Those are things that you should be writing off, but there are instances that maybe you can't, as I mentioned with a car, you can't write
Mm-hmm.
off the
Mm-hmm.
entire car. But the thing to do as you're working with your CPA is just to make sure that you present that information and let the CPA make the determination. And I think that's probably the biggest thing, making assumptions or trying to decide what is deductible, what's not deductible, when that's really something that you should be having your CPA to do because they're experts in the area.
Mm-hmm. Mm-hmm.
I
So,
Go ahead,
oh,
Judy.
okay. So let's start from the beginning. You
Hmm.
get a new job. You need to fill out your W-4.
Hmm.
That in and of itself is very confusing for people. They don't know what to put. They don't know how to complete that document. And I know that when the time comes for me to do it, it's like, wait, what am I supposed to put here?
Hmm.
How many
Yes.
things, how many, what am I claiming? So let's just go to the basic starting point. How do we fill that out? How do we know what to put on that document?
Absolutely. And they actually changed that document as of a couple years ago. It used to be that you did list the number of dependents and so forth. But what the IRS found is that people were claiming, let's say, 9 dependents, because what happened on the old form, if you claim 9 dependents or less, it didn't have to be reported to the IRS by your employer. If you put 10 or more, then your employer actually had to report it to the service. And so what the IRS did is they took that away, and basically they said, give me your name, give me your address, your social security number, and whether or not you want to take additional taxes out. And so basically what happens is they are taking the tax from the table, or based on your income from the table. You don't have the ability to kind of manipulate it so that you can have less taxes out.
Mm.
Basically, they're making it so that you have more taxes out. And so now really the thing that you have to consider on there is that within your household, is it a 2 household income or a 1 household income? And so it's still a little daunting because it's not the simplest form to fill out, but they have made it so that there aren't as many questions that you have to answer. So
Mm.
if there's 2 incomes, there's a little schedule that they make you consider the income that's the highest in determining what your withholdings are going to be for the year.
Mm-hmm.
And with
Mm-hmm.
that W-4 form, you can change it throughout the year. And
Mm.
so let's just say that, you have a certain amount coming out, and you feel, because you've talked to your CPA, or just because it just seems like that number's low, you can have additional taxes taken out. And it really depends also on the person. Some people, they don't want taxes taken out and they don't mind having a tax bill in April. But there are
Mm-hmm.
others that say, I'm not giving the government an interest-free loan. I want as little taken out as
Mm.
possible. You can't manipulate it as much through that W-4 form. What people are doing now is they're having side businesses. And so you can be a doctor, but as long as there's no conflict of interest with your employer, you can do a consulting business on the side, and then you're
Mm-hmm.
able to write off additional expenses so that can lower your tax liability.
So let me ask this. So I've been at my agency for over 7 years. I completed the old W 4. Are you saying that I should go and complete a new one now, or is the old one still fine?
Well, the old one is still fine. Usually it's
Okay.
when you change your job, but if you want to change your withholding, if you're not happy with it, you actually can fill out a new W-4 form and submit it to your employer.
Okay. Okay. Great. Great.
Mm-hmm.
Okay.
A lot of people will use apps and programs like TurboTax and things
Mm-hmm.
Mm-hmm.
like that, and they think they want to save the money on a CPA because it's like a nice chunk of change when you know.
Mm-hmm.
What's your feeling on people who do their own taxes?
You're probably leaving a lot of dollars on the table.
Yeah.
Sadly,
Hmm.
that's just the way that it is, because a TurboTax and even some of the small preparation services, they don't ask you the questions that need
Yeah.
to be asked. A CPA is, first of all, going to really get to know you. They're going to ask you all of
Hmm.
these additional questions to see if there are other deductions that you can take on your return. That's really what it is. You have a person who is experienced and can read through a lot of things, and then
Mm-hmm.
you have a software or platform, an app that really, it will ask you the basic questions, and you will get a return that's correct, but you won't get all the deductions that you are potentially entitled to.
Mm.
Can you go
Okay.
back if you find out that, oh, there I left stuff on the table? Can you amend your tax or your?
Yes, you
Uh-huh.
absolutely can
Okay.
amend your returns.
Hmm.
And the federal government, there's a statute of limitation that says that you can go back 3 years. And so if
Mm.
you amend your return within the 3 years, you can get your money. The interesting thing is that if you amend your return and the statute of limitation has passed, they technically don't have to give you your money,
Sure.
because you've got 3 years, and that works to your benefit in that after 3 years, they also can't audit you as long as there's, no significant errors on your tax return. The Franchise Tax Board in California, the statute is 4 years. And so each of the states are going to vary, but you absolutely can amend your return if you find that you've missed something.
How long should I keep all my receipts? Some people will keep it, 15, 20 years. When can I just toss that stuff?
Yeah, we recommend 7 years.
Mm-hmm.
And generally, as I mentioned, that statute is 3 years.
Mm-hmm.
If you have a larger mistake on your tax return, the statute is 6 years. If you never filed your return, or if you had egregious errors on your return, or you omitted income, or had excessive expenses, the statute never runs. And so if you are a taxpayer that follows the rules and doesn't, try to overdo it, after 6 years, and that's why we say 7, you can go ahead and destroy those documents.
Okay.
So, Kathy, does the same go for the actual filing? Because my CPA gives me a little folder every year, and I have them going back for, the last 15 at least. Do I need to hold on to those, or can I get
You,
rid of
you
them?
You actually can get rid of them. And working with the CPA, I'm certain that they have done everything that they needed to, cross the T's and dotted the I's. And so you shouldn't have any trouble past the 6 years.
Okay.
Fortunately, because of computer technology, we're sending tax returns electronically, and your
Mm-hmm.
documents, you can scan them and have them electronically. And so if you're feeling a little angst and not comfortable with the 7 years, you can hold them electronically, but you don't have to have those paper folders.
Yeah. Yeah, I have a bunch of them downstairs.
Mm-hmm. Yeah. Time to shred it. Time to shred
Yeah.
it.
Yes, yes.
Okay. So you mentioned one of those like life-changing tax implication events, um, your children going off to college.
Hmm.
So I have, I currently have one in college. Candy has one in college. Two of hers have graduated. So what's the big deal? Why do we need to make note of our kids going to college on our taxes? How does that benefit
Yeah, of
us?
course.
What's
Of
that like?
course. Well, a long time ago, most of us, depending on the school you went to, I went to a state school. My tuition was $400 a semester, and
Oh
I
my
just paid,
gosh. Mm-hmm. Wow.
based on an internship that I had. But my daughter, who went to USC, her tuition, room and board was $80,000, and so it wasn't something that she can get an internship and pay for. And so it was important because she has a form, a 1098T, based on what we pay the tuition, and it lets us know what tuition was paid and any scholarships that they may have received. And generally, what happens, because a parent is paying for their child's tuition these days, you may be able to get a write-off on your tax return.
Okay.
Unfortunately, for high wage earners, you don't actually get the benefit, but it's something that you still, would report on your return.
Right.
Also, students who go away to college, they're considered temporarily away from home. And so you can still claim them as a dependent, even though they don't live in your household. You still consider them as living in your household for those 12 months. Student loan interest, those type of things you can write off. And so really, it's all in the reporting. When it
Mm-hmm.
comes to the IRS, anything that is reported under your Social Security number, you need to make sure that that's on your tax return, even
Okay.
if it turns out it's something that you can back out. And let me think of an instance. Let's just say that you do work and you receive a 1099, but you have a single member LLC, which is a separate legal entity. It has its own tax ID number, but the person that you're working for, they don't want to pay your LLC. They want to pay you. And so they issue you a 1099. It has your social security number. You have to show that on your tax return, but then you also have a line item that says it's reported on your Schedule C for your LLC. So they see that it's coming in under your
Mm-hmm.
social security number, and then they see that it's being reported on your Schedule C, which
Mm-hmm.
has a separate tax ID number. And so you just want to make sure that everything is there.
Wow.
Okay. So, my head is in a fog,
I
but
know,
yeah,
honestly.
yeah. But
I'm like,
couple,
Schedule C, what the heck?
couple of
Oh.
yeah, couple of questions. You know, people
Hmm.
make donations to
Hmm.
charities,
Hmm.
and I think a lot of people believe, oh, if I gave $400 to this, I'm going to get a $400 tax break when I file my taxes.
No,
It's not a refund.
it is not. It is not a credit.
Yeah, yeah. So how much do I get? How much is credited?
Yeah, I usually tell people about 33%. And
Mm-hmm.
so, yeah, the highest tax bracket right now is 37%. And so that's the most anyone is going to pay on their highest amount of income. And so 33% is a good amount. So if you make a contribution of $100,
Mm-hmm.
then you will pay about $33 less in taxes. That's what's going to happen. It won't be like you said, it's not a credit. It's
Mm-hmm.
not dollar for dollar.
Right,
Mm,
right. So there are certain things I know which if the IRS sees it on your taxes, it's kind of like a red flag.
Mm-hmm.
Like I was told, like, you know, when you make car donations, it will if you make car donations, that's kind of a red flag. Is that true?
Yeah, and I would say kind of a red flag, but I'll say that it's something that they're going to take a closer look at
Mm-hmm.
mm,
because so many people have abused it. There's a form that whomever you make that car donation to, there's a form that company needs to fill out and provide to you, and that
mm-hmm,
information gets included on your tax return. And so you're absolutely right. And the IRS also has these statistics, if you will, based on the income that you make. They estimate that you make about, let's just throw out a number, about $30,000 in donations a year. Well, if your income level doesn't match that 30,000 and you gave
Mm-hmm.
50,000,
mm-hmm,
that's going to be a red flag or something
mm-hmm.
that they're going to look a little closer at. And so, um, when you have a Schedule C, and that is a sole proprietorship or LLC, income and expenses reported on your return, it's not a red flag per se, but it's something that they're going to take a closer look at because
Mm-hmm.
abuse can happen in those areas.
Right. Yeah.
Um,
Okay.
Go ahead. I was wondering about tax breaks because every time, like, I cannot believe that I paid more taxes than a lot of these billionaires. You know, there's a certain
Yes.
person who paid $700 in taxes, and single
Yes.
mother, me, is paying thousands of dollars.
Yes.
What's a good tax break that people, you know, can do or look into so they don't end up paying more taxes, but in a legal way? I know you get a break
Right.
from owning a house, but what
Mhm.
else can you
Mhm.
think of?
Yeah, well, that certain someone that you're talking about also changed the rules in that. So it's very difficult to change the tax law. It's just
Hmm.
something that's difficult for Congress to agree on. But through budget reconciliation, you can make changes in the law. And that particular administration, they actually made it harder for middle class Americans. You talk about being able to deduct your home. It used to be the property taxes and the mortgage interest on your home, and you can still do that, but when it comes to taxes you can only write off up to $10,000. And so if you live in California, New Jersey, New
Hmm.
York, some of those high tax states, your property taxes are going to be greater than $10,000
Yeah.
in a
Mm-hmm,
given year. But in addition to that, the income taxes that you pay, that your employer withholds and that you pay to the state, it's going to be far more than $10,000. And
mm-hmm,
so unfortunately, you're finding that middle class Americans are paying in more taxes because they're not getting those benefits. Another thing that was available was a 2% miscellaneous itemized deduction. And so if you were an employee and you incurred expenses and your employer didn't reimburse you, you used to be able to write those things off. let's just say like a professional athlete, they pay commission to their agents. Those things used to be, you'd be able to write those off, but that 2% miscellaneous itemized deduction is gone. So you can't write those things off. And so
Mm.
right now, the thing that we're trying to tell people is that you're going to have to do your best to defer taxes. And so you're going to have to max out your retirement, put as much as you can in there. You're going to have to make those charitable contributions so that you can, lower your taxable income and get a little bit of relief there. And then, as I mentioned before, having a side business where you can have additional expenses that you can write off. But it's really hard now. The good thing is that after 2025, all of those things that they change, they're going to sunset, and then 2026 is going to revert back to how it was. And you're
Mm.
going to see that you're probably not going to pay as many taxes as possible, or as much tax as possible.
Okay.
Well, that is good to hear. So you mentioned something, and I was thinking about this before, maxing out your retirement. So I
Hmm.
know, let's say you make $100,000 a year, and if I'm correct, you can contribute like 30,000. The max is
It
30,000.
Yeah, if it's in a 401k, it's 20,500 now.
Okay,
And it
okay.
does increase every year.
Mm-hmm.
But, I keep mentioning that side business. So if you have a side business and you're really earning income, you can actually create a SEP IRA. There's solo
Hmm.
401ks. There's some other platforms that you can use to sock away more money. And it can be in the upwards of $60,000. And
Mm.
so it really matters as you're getting that money in. And of course, with compound interest, and you can't
Right.
use it or pull from it until you're 59 and a half. And so the earlier you start doing that,
Sure.
the larger that money, that amount is going to be. And so yeah, I definitely maxing it out. And a lot of times your employer will match a certain portion of what
Mm-hmm.
you
Mm-hmm.
contribute. If you don't at least put in that much, that is really a horrible thing, because you're losing, you're leaving money on the table
Right.
essentially.
So what happens is when your whatever your salary is and the deductions that you're putting towards your retirement, that then lowers your tax bracket, right?
That's
So it's not a
correct.
hundred
That's
thousand dollars, it's $85,000. So
exactly.
now
That's
you're being
exactly
taxed
right.
on the lower amount. So that
Mhm. Mhm.
plays to your benefit because the taxes that you owe are less, but also your 401k is increasing, which is also to your
Right.
benefit. So,
Exactly.
okay, I'm explaining this just so I better understand it, and
It's
hopefully
it,
for those
Yes.
it
out
it
there.
sounds like you're working it out in your head while you're
Yes,
talking.
yes,
Yeah.
I actually am. Thank you.
Uh-huh.
Thank you.
Right.
This is the way I process.
Yeah.
Yeah,
Yes.
because
So,
I know that there are people out there that don't really understand that. So I just want to
mhm.
be as clear as I can be and
Yes.
understand it myself.
And that's perfect what you said. You're absolutely right. You do not pay tax on that income, and it's growing tax free. So all of the gains, you are not paying taxes on those gains as it grows. And so what happens is when you do retire and
Mm-hmm.
you take the distribution, it's only then that that money is taxed. And what people usually try to do, like if you think about it right now, as you're younger, you are trying to increase your income. You're making more and more, you're getting in the higher tax bracket, and so your taxes are going to be higher. At retirement age, the understanding, or what we believe, is that you're going to have a lower income. You're not going to have
Mhm.
that job that's paying you a
Mm-hmm.
lot of money. You're going to
Mm-hmm.
be in a lower tax bracket. And so as you're getting those distributions that are taxable, it's not as bad because it's going to be taxed at a lower rate, because you're not going to
Mm.
be making income as you did as you were growing in the companies that you're working for.
Okay, so keeping that in mind, so now let's say I'm 70 years old,
Hmm.
I'm retired, I'm now taking a distribution from my 401k, and
Hmm.
maybe it's $25,000 that I'm taking out of there. So now I'm going to be taxed on that 25,000, but it's going to be at a lower rate than
That's correct.
if, okay, okay. Connecting the
and that
dots.
yes, and it's going to be at a lower rate because your overall taxable income is lower. So we
Yeah.
have these
Right.
marginal tax rates, and as I mentioned earlier, the highest one is 37%, but you might be taxed at 15% or 22% because
Mm-hmm.
your income is going to be lower. That 25,000, that's going to be a very low marginal tax rate. And actually, because of the standard deduction and also itemized deduction, potentially, you can have almost no taxable income depending on what your distributions are and won't have
Mm.
to pay taxes at all.
Okay. All
So you
right.
get
Thank you for
taxed
that.
like a billionaire, right?
Right. Yeah,
Uh,
those, Warren Buffett always complained that his secretary paid more taxes than him, but
yeah.
the issue is that they are making or paying taxes in capital gains, and capital gains tax is at 20%. And
Mm-hmm.
so most Americans, we don't have, billions of dollars in stocks and bonds and
Mm-hmm.
so
Mm-hmm.
forth. And so we're paying taxes at ordinary income rates, which as the highest again is 37%. And so if you work for someone, and I'll just say even for a professional athlete that makes $25 million a year, you are not paying capital gains at 20%. You're paying tax at 37%. And we're just talking federally. We're not
Mm-hmm.
even talking about the states.
Right.
Mm-hmm.
And some people who are high earners, they'll move to another state. So I know people move to Nevada, right?
Mm-hmm.
So
Mm-hmm.
that they
That's true.
pay less in taxes.
Yeah, I was
Yeah. And
Mm.
just about to say that. There are some states
mhm.
that, the tax implications are far less than
Mhm.
California.
Right, right. California is one of the highest income tax states, but one thing that you do have to consider for those who are considering moving because of the high state tax is that the states do get money other way. There
Yes.
might be a higher sales tax or there might be property taxes, and so
Mm,
there are other things that you do have to consider
Y-
mm.
because these states, they need money. They need to
exactly.
have money to pay for all the things they need to pay for, and they will get you one way or the other.
Right. When
Thank you
I
for
lived in
sharing that. Yeah.
yeah, when I lived in Texas, there was no state income tax, but my property tax was probably double what I pay in California.
Yes.
Um,
Mm-hmm.
a question that came to me is, what happens if I have a child who goes to grad, like, is of course a dependent when they're in college. Maybe they work a few
Mm-hmm.
years, they go to grad school, and then I'm footing the bill. Can I claim them as a dependent after they've been independent?
You can if they're living with you. And
Okay.
so, but if
Mm,
they go off and move to another state or wherever away from your home, then you cannot.
Mm-hmm.
If you are basically 23 years old, but you're a full-time student, and you can be away if you're still doing undergraduate work, you can deduct them as a dependent. But
Mm-hmm.
yeah, once they're gone and they're not within your household,
Mm-hmm.
then no, you cannot deduct them as a dependent
Okay.
anymore.
Okay.
so,
All right.
Candy,
Hmm.
your kids just need to come home for graduate school.
Yeah,
Yeah.
I don't think they're gonna do that. I'm just looking for any type of loopholes or anything I can find. Yeah. So,
Okay.
what, like, being a homeowner, how much of my mortgage interest can I deduct? Is it just up to 10,000? That's it?
Well, so mortgage interest, you're okay.
Mm-hmm.
That those were state taxes that the
Okay.
limitation was put on.
Oh, okay.
But it depends though. Before 2018, you can deduct mortgage interest on a mortgage up to $1 million. Now, if you have a home, if you have the mortgage after 2018, it's only up to 750,000. And so, if you recently bought a home and your mortgage is $1 million, you can only deduct the pro rata portion of the interest up to the 750,000. And so, there's a little calculation that
Mm-hmm.
we have to do to make sure that a person doesn't deduct more than they should. And it's interesting that you mentioned that because that's one of the big areas that the IRS is looking at, people deducting more mortgage interest than they're supposed to. And let me also mention, when you look at the forms that you get, your W-2s, your 1099s, the 1098s, all of those things, there's information on there. And so when you talk about your mortgage interest statement, it shows what your loan is. It
Mm-hmm.
shows the date you took out your loan. It
Yes.
shows your mortgage interest. And so because of computer technology, the IRS can easily tell that you have taken more than you were
Mm.
supposed to. And so
Mm-hmm.
those are areas, anytime something is reported, you know that the IRS is going to be looking at it because they are asking those additional questions. If you look at your tax returns, once you get them, there's a Schedule 1, a Schedule 2, and a Schedule 3. Those schedules have a lot of new line items now. One that's very interesting, I have a few clients who are Olympic athletes. You actually have to report the value of the medal that you received
Are
from
you
the
Mm.
Olympics.
serious?
Yes,
Wow.
but the crazy thing is that on the other schedule, you back it out the same amount, but they
Mm-hmm.
want it reported
Mm.
because they are looking at that. And I don't know if one day they're going to say, okay, we're going to make this taxable. But for some reason, they have a separate line item and they want to see those things right now. And so, um, anything when it comes to taxes, it's public policy. Whatever the IRS wants to encourage, they make it so that it's tax-free or not deductible. Whatever they want to discourage, they make it taxable and not deductible. And
Mm-hmm.
wait, did I say that backwards? So if they discourage it, they want to make you not be able to deduct it and include it in
Mm-hmm.
income. If they
Mm-hmm.
want to encourage it, usually they don't have it in the income and you can deduct it. And let me give you an example because broadly, it makes more sense if I give an example. And so years ago, you used to be able to deduct credit card interest on your tax return, but
Mm.
the IRS determined that Americans were going into debt at high levels
Right.
and they wanted to discourage it. And so it's not something that you can deduct on your return anymore.
Mm.
And so you can look at a lot of things like, oh, they give you a deduction for this. Oh, they must want me to do that. Oh, they penalize me for that. Like as an example, taking your retirement money out before you're 59 and a half,
Right.
they
Yeah.
want to
Mm-hmm.
discourage it. So there's a
Make it.
10% penalty if
Mm-hmm. Mm-hmm.
take an early withdrawal. But
Right.
they have some exceptions if it's an IRA, for instance, if you're buying a home for the first time, well, you can take up to 10,000 out without a penalty because they want to encourage home ownership. And
Mm.
so it's really interesting. You know, you look at some of
Mm-hmm.
those line
Mm-hmm.
items like, why are they asking for that? Or why are they giving a benefit for that? It's because they're trying to, use the system as a way to encourage people to do or not do
Right.
things.
Hey,
Question.
Kathy.
Oh, go
Oh,
ahead, Judy.
so I'm thinking in this day and age, a lot of us have a side hustle, right?
Mm-hmm.
Trying to make a little bit of something, something on the side.
Mm-hmm.
Um, and let's say I'm making baby blankets, right?
Mm-hmm.
And people are ordering blankets and I'm making them, sending them out. But what if my business is just starting and it's not making money? Can I still include that on my taxes and show that I'm taking a hit on this? How does
Absolutely.
Because somebody once said, "Oh no, that's just a hobby. You're not
Ye-
making money, so we can't claim it. That's totally on you." Is that accurate?
Right. And so the way that it goes is the IRS wants you to make income in 3 out of the 5 years to say that it's a viable business.
Okay.
However, that in itself doesn't say that it's a hobby. If you are actually incurring those costs because you are trying to make money, it is a business and you can write those things off. And
Mm.
so I'll use as an example an actor. We all know that within the entertainment business, it's feast or famine, and you cannot always find work. But you're incurring costs because you're,
Mm-hmm.
getting headshots and you're doing all these things to always be ready.
Right.
You can write those things off. You might not get a job for 10 years, but you are actively out there doing your craft. And the IRS is not going to say, oh no, you've tried long enough. This is a hobby. We don't believe that this is something that you can write off. And so really one of the things they look at is, do you have a separate bank account for that?
Mm-hmm.
When you start acting like a business and you're treating it like a business, it shows that it's not a hobby. Many people who get burned on something like that it's because they're kind of going willy-nilly. They don't have a separate bank account. They've not kept accounting records, and that's important as well. We talked about receipts earlier. I know every business doesn't require you to have an accounting software to track everything, but you need to be doing something. You need to have an Excel spreadsheet. There needs to be something that shows that you are tracking it, that you have a profit and loss statement so that you can see what you're bringing in or see what the expenses are going out. And so to answer your question, if you are acting like a business, then more than likely, whether you make money or not, you will be able to write that off without a problem.
But you have to
Wonderful.
have a separate bank account. Do you need
Right.
to be incorporated? Do you need an
No,
LLC? Okay.
no, you don't need to be incorporated, but still definitely a separate bank account. Yeah. And with that, when you're a sole proprietor, let's just say Chase as an example. You can have a personal bank account or you can have a business bank account at Chase. And what a lot of people do is they say, "Oh, well, the business account costs a lot more money, than a personal one." And so some people end up making two personal accounts, but as long as all of the business expenses are going through one account, again, you're treating it like a business. You're not commingling funds with your personal funds, then you are showing that you are actively conducting business.
Okay.
Okay. All
Good to
right.
know.
Yeah. How do we write off two Soka,
I
Candy?
know. I know. I know. Yeah. 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 Um, Gosh, I had a question I can't think of. Oh, you mentioned taking $10,000 out the IRA. Do you have to pay it back?
No,
Oh,
no,
okay.
you don't have to pay it back, but although you don't pay penalties on it,
Mm,
when you take the distribution, it does get taxed because it wasn't taxed before.
Mm-hmm.
So,
okay.
but you're not penalized, and you do
Okay.
not have to pay it back. The one thing, well, there's a couple things with retirements. If you do have a 401k, you can still take money out as long as you get it back into another plan within 60 days.
Right.
Um,
Right.
you also can take loans from your retirement. But the one thing when it comes to loans, you have to be very careful because if you leave the company that you took a loan out from, that money is going to stay as a distribution, and so then you're going to end up having to pay taxes on it. They may give you a period. I'm not sure if there's a period where you can quickly pay it back. But anytime you pay a loan, you have to make sure to get that money back into your retirement. Otherwise, it's going to be considered a distribution, and you will have to, pay penalties on that, and of course taxes because you never pay taxes on that income.
Okay.
So let me clarify just for a second. Again, taking 10,000 out of your 401k to purchase a home, no
Hmm.
penalty. However, it is taxed, so that $10,000 isn't going to look like $10,000. It might look like 9,000 something something. So people should bear that in
Right.
mind as well.
Yeah, yeah, and it's just going to be another item on your tax return. It's going to show as a distribution, but you're going to check a box that said that it was one of the exceptions, and therefore you
Okay.
won't have the penalty. But you're absolutely right. At the end of the day, it is going to be a little less than that 10 because you pay
Okay.
taxes on it.
Sure. Sure. Okay.
All right.
Wow.
Well, a couple of things I know is if you don't file electronically, remember to sign your tax return.
Hmm.
Okay.
And
And
date, and
it's
date.
sign and date. And
Hmm.
don't wait till April 13th
Mm-mm.
to send your
Mm-mm.
stuff to your accountant because there's going to be a bunch of people who did it. You might ask
Hmm.
for need an extension. So just take care of it,
Yes.
Um, since I have a kid in college, I have to do mine early so that I need to fill out the FAFSA so she can get her
Hmm.
scholarships, all of that stuff.
Hmm.
But don't wait because, these accountants, I mean, like they're busy. They're
They're
busy,
busy.
Yes,
you know?
yes.
Yeah,
So
yeah.
busy.
And I mean, you can always file for an extension, but you're going to have to do it
Yes,
anyway. So,
Mm-hmm.
yeah.
I,
absolutely. You
I,
are
I
so
will
right.
Uh-huh.
also, I do also want to point out that there have been times in my life where it's like, ooh, I have a tax bill, right? I owe money. And what I have learned or my experience is if you make a payment plan and you pay it, nobody's coming looking for you. You don't need to be
No.
Yeah.
afraid that someone's going to knock on
Yeah.
your door or you're going to have your paycheck garnished. Just make a
Right.
plan with the IRS
Mm-hmm.
or your state or federal and pay it off
Mm-hmm.
in whatever increment you can manage. So
Yes.
Right.
I've learned
Yes.
that. I mean, I wasn't happy to have to pay it back, but I've learned that if you make the plan, it's doable and no one's going to be hounding
It
you.
Hmm.
is.
Right. Right.
You are so right about that. That's that kinder, gentler IRS that I was talking about. When those notices come to you, or if you can't pay, always
Hmm.
file. That's an important thing as well. Some people say, "Oh, I don't have the money, so I'm not going to file." The problem is if you don't file, you'll get a penalty for failure
Right.
to file. And you
Right.
don't want that.
Yeah.
File that tax return, attach an installment agreement request, or even if you don't put the request, you can request it later. And as you said, pay it over time, and no
Yeah.
Yeah.
one's going to bother you at all.
Right.
Right.
And
Right.
then also want to point out that scammers, people call you who say you owe this to
Mm-hmm.
the IRS, pay over the phone. The IRS is always going to
No.
reach out to you via mail.
Hmm.
Yes.
Okay.
Hmm.
So don't fall for the kind of urgent, pressing phone call from the so
Yes.
called IRS.
Right.
Absolutely.
Hmm.
And if you do get something in the mail, sometimes you're afraid that it might not be real. Call the number to the IRS.
Hmm.
That is the actual
Hmm.
number, which is,
Yeah.
what is it? 800-829-1040. I believe the
Hmm.
number is. Call them directly. They'll pull up your information based on your social security number, and they will let you know where you stand. But
Hmm.
you're absolutely right. The enforcement doesn't happen until you do not answer them. But
Right.
I also should throw in, make sure that your address is always current. If you
Hmm.
move and you don't file a tax return, they have your old address, and they may have been sending notices to that old address.
Right.
And
Right.
so there's a form that you can put a change of address, or, as we know, just file your tax returns each year.
Hmm.
That way they
Hmm.
will have your current
Yeah.
address.
Yeah.
Mm-hmm.
All right. Well,
Those are
these have
some
been
great
great
tips.
tips.
Yeah.
And for the people listening, you might want to write stuff down because we got some really good information. But nobody
Hmm.
wants to be in jail for failing to pay taxes like Wesley Snipes or,
Right.
I am too pretty for jail. So
Yes.
um,
Yes.
thank you for listening to this edition of Soka with Kathy Shirley. Kathy, how can people find you or reach out to you if they need a CPA?
Absolutely. So my company is World Management Solutions out of Calabasas, but my email is kshirley@worldmgmt.net. Our number is 310-601-7500.
And you don't
Wonderful.
have to live in California to use Kathy.
That's correct.
Yeah. Okay.
Okay.
All
And then,
right. Well,
Kathy, when
great.
we do publish, we will make sure to include your contact information there as well. We really do want to thank
Okay,
you for coming
sounds
on with
good.
us today and for sharing your vast knowledge and expertise around this area because I think it's something that's really daunting to the majority of the
Yes.
public. So being able to have a conversation with you to maybe better understand, I know it makes me feel better as I move into this
Good.
season. So thank you so much for being with us today.
You're welcome. Thanks so much for having me.
Bye.
Bye-bye.
Okay. Well, thank you for listening to this edition of Soka. You know where you can find us. We are on Instagram at Two Sisters of a Certain Age. You can find us on YouTube at Soka, and you can reach out to us at our email, which is twosokapodcast@gmail.com.
Don't forget to like, review, and share with family and friends. We would love to have you help us grow our audience and spread the word that at Two Sisters of a Certain Age, we can relate. Thanks, everybody.
No